What if you spotted the perfect trade? The chart is screaming buy, the momentum is there, and you're about to capitalize on the opportunity you've been waiting for. A lot of people believe that's how crypto trading works, that if you're fast enough and smart enough, you'll catch the wave. But there's something you need to know. If you're watching this, there's a good chance you've placed trades in crypto, or you're about to. And here's the truth most people won't tell you. Executing a trade is easy compared to protecting it. I've watched traders lose thousands of dollars in a single transaction, not because they picked the wrong coin, but because they didn't understand what happens in the 3 seconds between clicking buy and seeing the confirmation. The moment you submit that order, it enters the mempool, the blockchain's waiting room. And here's what nobody talks about. You're not alone in that waiting room. High-frequency bots are scanning every transaction, looking for opportunities to jump ahead of you. They see your intent before it becomes reality, and they're already moving. The fastest way to lose your edge and your capital is to trade like the blockchain is fair. It's not. Every public transaction is visible, and sophisticated operators are using that transparency against you. This is called front-running, and if you don't understand how it works, your portfolio is being taxed by invisible thieves every single time you trade. Let me show you exactly what happens when you click that buy button. Your transaction doesn't execute instantly. It can't. Every trade on a blockchain has to be processed, validated, and added to a block. Before that happens, your transaction sits in something called the mempool, the blockchain's waiting room. Think of it like this. You've just announced your intention to buy $10,000 worth of a token. You've shown your hand. And here's the problem. The mempool is completely public. Anyone with the right tools can see your transaction sitting there waiting to be confirmed. They can see the token you're buying, the amount you're willing to pay, and most importantly, how much slippage you've allowed. This is where crypto is fundamentally different from traditional markets. When you buy a stock, your order is processed privately through your broker. Nobody sees it coming. But on a public blockchain, transparency isn't a feature when you're trying to execute a trade. It's a vulnerability. You can't move quietly. Every transaction is broadcast to thousands of nodes, and every sophisticated operator in the network can see it. The mempool is supposed to be first come, first served, but here's what they don't tell you. Miners and validators decide which transactions get processed first, and if someone is willing to pay a higher gas fee than you, their transaction jumps the line. This isn't a bug, it's how the system works. So while you're sitting there waiting for your confirmation, thinking you're about to get your token at the price you saw on the screen, bots are already calculating whether they can profit from your transaction. They're not hoping, they're not guessing, they're running the numbers in milliseconds, and if the math works, they're moving. By the time your order confirms, the price has already changed, and you paid for it.
Here's how they actually steal from you. It's called a sandwich attack, and once you understand it, you'll never look at a failed trade the same way again. You submit your buy order for a token. Let's say you're buying at what you think is $1 per token. Your transaction enters the mempool, visible to everyone. A bot sees it immediately. It calculates that if it buys the same token right before your order executes, it can push the price up. So it submits its own buy order with a higher gas fee, ensuring it gets processed first. The bot's order executes. The price jumps to $1.05. Now your order executes at this new, higher price. You just paid more than you intended. But the bot isn't done. Immediately after your order goes through, it sells the tokens it just bought back into the market at the inflated price you created. The bot profits. You lose. You've been sandwiched. The bot bought before you and sold after you, using your own transaction to manipulate the price in both directions. And here's the worst part. You probably didn't even notice. You saw some slippage, maybe chalked it up to market volatility, and moved on. But it wasn't volatility. It was theft. This happens thousands of times a day across every major decentralized exchange. The bots are faster than you, better funded than you, and they have zero emotion. They're not trading on speculation or hope. They're extracting value from predictable human behavior, your behavior. The larger your trade, the bigger the target on your back. That $10,000 buy order, That's a feast for these algorithms. They see the liquidity impact you're about to create, and they position themselves to consume the wealth you're about to generate. Every single time you trade without protection, you're paying an invisible tax directly into their wallets. Now let's talk about the setting that most traders completely ignore, the one that determines whether you get sandwiched or not. It's called slippage tolerance, and if you don't understand it, you're handing these bots permission to rob you. Slippage is the difference between the price you expect and the price you actually get. Some slippage is normal. Markets move, liquidity shifts, but here's where traders make the fatal mistake. They set their slippage tolerance way too high because they want their trades to go through quickly without failing. You set your slippage at 5% because you're impatient. You don't want to see that failed transaction message. You want execution. So you give the protocol permission to complete your trade even if the price moves 5% against you, and the bots know this. They can see your slippage setting in the mempool. They know exactly how much room they have to manipulate the price before your transaction fails, so they push it right up to that limit. You wanted 5% slippage tolerance? They'll take 4.9% of your capital every single time. This is the price of ignorance. You thought you were being smart by ensuring your trade went through, but you were actually broadcasting your pain tolerance to every predatory algorithm watching the mempool. You told them exactly how much you were willing to lose, and they obliged. Most traders don't even check their slippage settings. They leave it on default, usually somewhere between 1 and 3%. That might not sound like much, but on a $10,000 trade, 3% is $300 gone before you even start trading. Do that 10 times, and you've lost $3,000 to completely avoidable execution costs. The discipline isn't in finding the perfect entry. The discipline is in protecting that entry from being exploited the moment you click buy.
So how do you actually protect yourself? You can't trade invisibly on a public blockchain, but you can make it significantly harder for bots to exploit you. And that requires the right tools, not just the exchange interface everyone else is using. First, understand this. The default RPC endpoint your wallet uses is public. Every transaction you submit goes through a node that broadcasts it to the entire network. That's the mempool we've been talking about. But there are alternatives. Private RPCs and private relay services like Flashbots allow you to submit transactions directly to block builders without exposing them to the public mempool first. Think of it like this. Instead of shouting your trade intentions in a crowded room, you're whispering directly to the person who decides what gets included in the next block. The sandwich bots never see your transaction coming. They can't front-run what they can't see. This isn't some advanced strategy reserved for institutions. These tools are available to retail traders right now. Flashbots Protect is free. Private RPCs are often free or cost pennies. But most traders don't use them because they don't even know they exist, or they think the default settings are good enough. Second, tighten your slippage settings. 0.5% is aggressive but protective. Yes, your transaction might fail occasionally if the market moves against you. That's not a bug, that's the system working exactly as it should. A failed transaction costs you a small gas fee. A successful sandwich attack costs you hundreds or thousands of dollars. Third, consider breaking large orders into smaller chunks or using limit orders when possible. The bigger the trade, the bigger the target. Sophisticated operators use order splitting and strategic timing to minimize their footprint. You should too. You don't need to outsmart the bots. You just need to make yourself a harder target than the person trading next to you. Here's what separates the traders who build lasting wealth from the ones who flame out. It's not about making the perfect trade. It's about protecting every trade you make. Because you only have to get rich once, but you can get poor 1,000 times through 1,000 tiny mistakes. Most traders obsess over entry points. They study charts for hours, wait for the perfect setup, then execute without thinking about how that execution actually happens. They spend 99% of their energy on the trade and 1% on the execution.
That ratio should be reversed. The best trade in the world means nothing if you lose 3% to a sandwich attack, another 2% to excessive slippage, and another percent to inflated gas fees because you didn't optimize your transaction. That's 6% gone before the market even moves. Do that consistently and your edge evaporates. Your winners get smaller, your losers get bigger, and eventually you're wondering why you can't seem to get ahead despite being right about the market direction. This is why protecting your execution matters more than the trade itself. A sophisticated operator understands that preservation comes before performance. They know that keeping what they earn is harder than earning it in the first place. They use private relays. They set tight slippage parameters. They split large orders. They trade like someone is actively trying to steal from them, because someone is. The invisible tax on your trades isn't going away. The bots aren't getting slower or less sophisticated. The only variable you control is how much access you give them to your capital. Every unprotected trade is an invitation. Every default setting is a vulnerability. You don't need to be the smartest trader in the room. You need to be the most disciplined, because in the end, the only rule that matters is this: protect your execution or watch your portfolio slowly bleed out to algorithms that never sleep and never stop hunting.